Get some reaction to the Fed minutes and to that. We've been talking about it all morning. We did on Squawk Box too, waiting for that BLS revision, which happens every year.
It was like 10:30 by the time it came out.
It was a half hour late, which is not supposed to happen. I mean, how long does it take? You're already revising numbers that are screwed up. Now you're screwing up the screw up. It wasn't a screw up, actually. Bill Lee was an incredible pitcher, spaceman, but he's also chief economist at the Milken Institute. Bill, it's good to see you. I almost said good morning. Old habits die hard. Can we just start and put that to bed this morning? Every year it's done. This was one of the larger revisions, I think the largest since 2009. It was still a solid job market, whether it's 240 or 170, give or take. Still pretty solid. I didn't know this morning whether it would be bullish or bearish for the markets, because if it's not as hot as we thought, it gives the Fed more leeway, doesn't it? Was it a disappointment this morning that we lost some private sector? It wasn't even losing them. We just counted it differently.
Exactly. In fact, it's a sigh of relief to most economists that that number came down, and came down with a hefty number, because 200 plus 240, 250,000 a month average is way too hot for the normal economy that's slowing down to a more steady state pace. Closer to normal is actually not just 175, but closer maybe to 100 to 125. So because that's what's needed to just keep the people who are coming into the labor force employed. And so we're looking for numbers that kind of converge down to that eventually. So even at 175, it's still a pretty strong economy, especially when you compare it to the other series that the labor puts out, which is about unemployment. When they ask how many people have gotten new jobs, that has average from January to July, something like 90,000. So we knew that these two series had to converge, and the fact that it did is a sigh of relief, because we can't have this kind of divergence, because that's clearly a miscounting that Chair Powell told us about.
Someone said, you have 160 million jobs or 159.2 million jobs. That probably doesn't, in the country, that probably doesn't push the Fed one way or another. But given that brief growth scare that we had a month ago, and the VIX spiked, and suddenly the soft landing narrative was in question, does this do anything to either allay those fears or rekindle those fears that maybe the Fed is late?
Not at all. In fact, those fears had me scratching my head. How can you have a recession when there are no layoffs? And how can you have a recession when the unemployment rate went up because people thought, gee, this is a good time to look for a job. I shouldn't stay home anymore because jobs are plentiful. So it really is a sign that with a high participation rate and increase in the labor force, that people are perceiving the economy as doing quite well. Now, Emily did say that in the minutes, the FOMC did talk about the slowing discretionary consumption and how it is that the consumer might be slowing. That is a concern, because right now, all of us have been thinking, well, where is the consumer finding the income? Since January this year, the pace of consumption has outpaced income growth. And right now, the gap is several percentage points. So they're clearly dipping into savings. But when you look at households, who's got the savings? The stock market wealth that people have talked about, and the real estate wealth and pension wealth, that's in the top 50% of the population. When you talk about the lower 50%, they hold maybe 2% of all stock market and pension wealth. So it's really the top earners that have been doing the consumption, and even they are starting to slow down. That has got the Fed concerned about where it is that consumption may gravitate toward.